Welcome to Trading Psychology Journal, where we dive deep into the emotions, mindset, and discipline that shape every successful trader. Today's episode, Why 95% of Traders Can't Stop Trading Against the Trend, is one of the most important lessons in day trading for beginners. You've probably heard this saying hundreds of times: trend is your friend, follow the trend. Every trader has heard it, every trader knows it's true, and yet, time after time, they still end up trading against the trend. Why? Why do we, as traders, keep doing the very thing we know will destroy us? Why can't we stop fighting the market? It's not because traders are stupid, it's not because they don't understand technical analysis, it's because emotions are stronger than logic. When you're trading, especially when you're watching every candle tick up and down, your emotions are louder than your plan. Logic whispers, but emotions scream. Every trader starts out believing they'll be disciplined, but the moment real money is on the line, something changes. Your heart races, you see price move without you, you feel that sharp sting, the pain of missing out. And suddenly, all your rules disappear. Let's talk about the most common emotional trap. FOMO, the fear of missing out. Imagine this: you're watching day trading crypto or day trading forex, and you see Bitcoin or EUR/USD flying straight up. You miss the entry. You watch the candles get higher and higher. And your brain screams, it's gone too far. It has to come down. So you do something you swore you'd never do. You hit the sell button against the trend, trying to catch the top. You tell yourself, I'm not greedy, I'm just being smart. Overbought. But a few minutes later, price keeps climbing. Your stop loss gets hit, and you sit there staring at your screen wondering how you broke your own rule again. Sound familiar? That's what happens when emotion hijacks reason. FOMO tricks your brain into believing the market owes you another chance, that you can't just let it go without you, and that's the moment most traders lose. The second reason traders keep going against the trend is overconfidence. Many day traders, especially after a few wins, start believing they can outsmart the market. They think they can catch the top or call the bottom before anyone else. In day trading stocks or day trading forex, it's common to hear traders say, I can feel a reversal coming. But here's the truth: nobody can feel a reversal. That's not intuition. That's ego disguised as instinct. The market doesn't care what you feel, it doesn't care what you think, and it will crush anyone who tries to prove they're smarter than the trend. So when you think you're catching the top, you're really catching a falling knife. The third reason traders go against the trend is lack of structure or discipline. Most traders don't have a written trading plan. They have ideas, not rules. They trade from emotion, not execution. If you don't have a clear plan that says exactly when to trade, when to stay out, and how to manage your risk, then every red and green candle becomes an emotional decision. That's not trading. That's gambling. A professional day trader doesn't guess. They follow process and probabilities. They trade with calm, not emotion. That's why how to day trade is not just about entries and exits. It's about training your mind to follow structure, even when emotions are screaming at you to do the opposite. Another powerful reason traders trade against the trend is the illusion of missed opportunity. When price has already gone a long way in one direction, let's say you're day trading crypto and see Bitcoin pump 10%, you feel that painful thought, I missed it. But your brain doesn't stop there. It quickly adds, if I miss the up move, maybe I can catch the reversal down. So you jump in, shorting a strong uptrend, thinking price must reverse soon. You convince yourself that's logic. But it's just your ego trying to avoid regret. We don't trade reversals because they make sense. We trade them because we want to erase the pain of missing out. It's an emotional reaction disguised as analysis. Another factor, especially for beginners in day trading for beginners, is the illusion of small risk. When traders start with small capital, like $50 or $100, they think, it's fine, I'll just try this setup, maybe it reverses. That's not trading, that's testing luck. And it's the fastest way to build bad habits. Even if they get lucky once or twice, the long-term habit of fighting the trend destroys them later, when they start trading bigger size. You don't rise to the level of your goals. You stay rise the chu foninen near dalibri torsteinen the level of your habits. If your habit is to fight the market, you will always lose, no matter how big your account becomes. Now, how do you stop this destructive cycle? How do you train your mind to only trade with the trend? Let's go step by step. 1. Multi-timeframe confirmation. Always confirm the trend across multiple time frames. Use the MA200 rule. Only buy when price is above the 200 moving average on the 1H, 15M, and 5M charts. Only sell when price is below the 200 moving average on all three. This simple rule filters out 80% of bad trades. It keeps you aligned with the market's real direction. Whether you're learning how to trade crypto, how to trade stocks, or how to trade forex, this rule applies universally. 2. One direction. Only rule. At the start of each trading day, look at your chosen market, say, gold, Bitcoin, or NASDAQ. Decide your direction for the day, buy only or sell only. Write it down. Put it on a sticky note right next to your monitor. If you see a setup against that direction, ignore it completely. You're not missing an opportunity. You're protecting your capital. 3. Start with the big picture. Never start from the 5-minute chart. Always start from the top down. Daily. 4H, 1H, 15M. The higher time frame shows the real trend. The lower time frame only shows temporary noise. If the daily chart is going up and the 15-minute chart is pulling back, don't sell that pullback. Wait patiently and buy when the trend resumes. That's how professionals enter high-probability trades. 4. Keep a trading journal, especially for emotions. Every time you break your rule and trade against the trend, write it down. Note the time, the setup, and, most importantly, what you were feeling. Ask yourself, what emotion pushed me into this trade? After 5 or 10 entries, you'll notice a pattern. It might be FOMO, revenge trading, or overconfidence. Once you see that pattern clearly, you'll start catching it before it happens. That's how real psychological growth begins. The market is not your enemy, it's your mirror. It reflects your fear, your greed, your impatience, and your discipline. If you keep fighting the trend, you're not fighting the market, you're fighting yourself. But when you align with it, when you stop trying to predict and start following, trading becomes peaceful, calm, almost effortless. That's where mastery begins. So next time you open your chart, pause, breathe, ask yourself, am I following the flow or trying to force my will onto the market? That single question could change your entire trading career. If this message spoke to you, replay it before every trading session. Let it remind you that emotions are temporary, but discipline is forever. You don't have to be part of the 95% who keep trading against the trend. You can rise above that. You can train your mind to trade with clarity, patience, and calm. This is Trading Psychology Journal. And remember, your greatest edge is not your strategy, it's your state of mind.